Okay, before I dive into market data today, yesterday, of course, markets were closed being Columbus Day, but this was a very, very difficult and sad and dangerous weekend that we all experienced with what's happening in the Gaza Strip area in Israel and the fighting there and invasion of Israel. Uh, Very serious things, very serious times. There's a lot, of course, politically that's happening around the world and responses from the United States and others. I sure hope and pray that this doesn't expand into a larger regional conflict that draws in more countries and lasts longer than is necessary. Hopefully, things can be contained. Israel can make their response quickly and move things forward in a way that, that brings peace to the area. But it's just a scary time in the world when we have these major conflicts, right, that are breaking out now in the Middle East, as well as the ongoing conflict, of course, between Ukraine and Russia. All these things bring, a sense of instability and insecurity to people, and that's not what any of us want for our lives or for our children. So I pray for peace, that it happens swiftly, but in the right way, so it can be lasting. That, of course, has had an impact, switching gears a little bit here now into markets, like we need to talk about today. That has had an impact on the markets. And I'll go into that here in a minute and discuss how that conflict has had an impact on the bond markets and interest rates over the weekend and how that's affecting things this week. To start out with those, let's backtrack just a little bit to Friday, because Friday, if you recall, we had a big report coming out, a big jobs number. Every month we have the Bureau of Labor Statistics come out with the jobs numbers, and it came out looking at face value like it was great, right? If you see here on my chart, we showed 336,000 jobs, new jobs on the headline number coming out for September's jobs versus $170,000 or 170,000 low estimate on jobs. So a lot more than jobs created than were expected. However, there have been some revisions over the past 2 months. As you can see here, there were 119,000 new jobs added from the last two surveys from August and July. All of those jobs were government jobs. So that's not necessarily not indicative of an expanding economy when you have government adding jobs, but they are jobs nonetheless. So they were added back in. However, there are seasonal adjustments that are made consistently throughout the years. This particular jobs report had a ton of criticism. I mean, there are so many people critical of this jobs report that it's not even close to reflecting reality. If you take in the raw non-seasonally adjusted numbers, we would actually have lost 885,000 jobs. That's how bad this report appears to have been. Part of that was like September, government job gains of 70,000 of those government job gains were teachers. Yeah, duh, right? Teachers come back to work in August and September every single year. So why do we suddenly have this job gain of 70,000 that's not seasonally adjusted correctly? Big question mark there. What about retail? Retail jobs showed up 20,000 jobs in the BLS report, but the Challenger report, that's a more current private party report on retail jobs and the retail sector, reports a sharp rise in retail layoffs. So that's not jiving. And then leisure and hospitality, which all year has been kind of outperforming, right? We see these huge job gains in leisure and hospitality throughout the year. Came up big in BLS, but hotel occupancy has fallen over the past month. So that doesn't jive. So there's a lot of things that aren't jiving here and are making people wonder what in the world is going on. Now, one part of the jobs report that you should pay attention to, this is the business portion of the report, what I just discussed here. There's also a portion of the report called the household survey. Let's go to that real quick here for a second. So here's the household survey. BLS household survey portion of the report is when they do those the robocalls or whatever, but the random household phone calls to get statistics on what's going on in households. So in that report, the unemployment rate remained at 3.8%, but jobs were only up 86,000, not 336,000, only 86,000 new jobs. Full-time jobs dropped 22,000 and over 692,000 full-time jobs over the past 3 months over the summer have been shaved off this household portion of the report. That's not a good sign. The past 3 times this happened, like I said here on the chart, was 2001, 2008, and COVID. Okay, right before recessions happen. So it's another indicator that a recession seems to be looming on the horizon soon, very soon in the next 6 months or so or less. Part-time jobs were up 151,000 and multiple job holders up 123,000. This does not portend a strong economy. This does not reflect a strong economy. When you have more part-time jobs increasing, full-time jobs being shed, not a good sign for the jobs economy. So wage pressure inflation that the Federal Reserve is really concerned about, continuing to keep inflation up, may soon be ebbing based on all of this that's coming out on the household report. So that's what happened with the jobs numbers. The headline increase of 336,000 did cause a wobbling in the mortgage-backed securities. The price of the mortgage-backed security fell dramatically Friday morning when that report came out, but then it recovered most of the losses throughout the day on Friday as people dug in, as investors dug into the details that you see here and said, oh, this doesn't actually look as strong as the headline made it sound. Okay, so that's the synopsis for the jobs report. So now let's talk a little bit about what the charts look like right now with the Israel-Hamas conflict and how has that affected them. Okay, let's take a look here. First, let's talk about the 10-year Treasury. 10-year Treasury, of course, is a leading indicator of mortgage rates. And so what we've seen here at the 10-year Treasury is the yield has risen, right? We've been in this upward trend for a few weeks now, almost a month and a half of rising yields, which means interest rates are rising as well. However, this is Tuesday. Today, we saw the yield fall dramatically. So what you can do here is kind of a cool little tool I'll show you. You can draw a line here to kind of see, okay, what does this mean? Which direction technically does it look like we'll be able to head here? So if you kind of draw a line and connect the bottoms, right, of all of these candlesticks going back a few weeks. I'm not a very good artist here. That actually points a line right through or right above the drop we've seen today. So what that tends to mean is if this closes and continues to close throughout the afternoon here where it's at, it's possible we could see some follow through the next day or two of lower yields, especially as uncertainty continues around the Israel-Hamas conflict, right? And those yields falling back down to this level of the 25-day moving average or this Fibonacci line here could cause an improvement in interest rates even more than we saw over the weekend. We saw a bit of an improvement here over the weekend, probably an 1/8% or so, not a huge improvement, 1/4% max with some investors, but you could get another 1/8 to 1/4% potentially over the next few days. Now, part of what's going to drive what happens in the next few days with interest rates, of course, is inflation reports. We have the wholesale producer price inflation report coming out tomorrow, and then the consumer price inflation report coming out as well this week. So there's a lot of big news stuff, plus some auctions, some major bond auctions happening this week. So a lot that can move the needle throughout the week this week. I'll do a whole synopsis on what happened this week next Monday, and I'll do a few Instagram, short reel type posts as well, stories on what's happening on a more day-to-day basis as things happen this week with inflation reports. That'll be very interesting. So that's where we're at there. Looking at the mortgage-backed security chart, this is your 30-year mortgage-backed universal mortgage-backed security. Of course, it's the opposite, right? This shows price, not yield. So price falling means rates are rising. Price rising, like we're now seeing over the last 5 days, means rates improving slightly. So we've seen a bit of an improvement here. As you can see, there seems to still be quite a bit of room where we could potentially see more improvement, getting back up towards that 25-day moving average line. 25-day moving average kind of acts like a magnet. It's kind of a leash effect, right? So as you can see, you don't get too far removed at any time from the 25-day moving average, below or above, before you're snapped back to it. And we're pretty far below. So there's room here for some improvement on mortgage-backed securities. So it would be wise just to watch the next couple of days. If you are buying a house or you have a client who's buying a house that may want to lock their rate, make sure they're working with a loan officer who's paying attention to the markets, can kind of follow what's happening, because it might make sense to wait a day or two to lock, but you're going to definitely want to watch this closely. So that's the update for today. Have a good rest of the week. We'll be in touch soon.